Have you ever wondered what keeps the American economy afloat? For a long time, the answer was China. Back in 2013, China held a staggering $1.3 trillion in US Treasury bonds. That's more than the entire economy of Mexico. They were, in essence, America's biggest banker. Today, that number has plummeted to $775 billion, a 40% drop, and it's still falling. China isn't just buying less. They are actively, deliberately selling off their holdings, month after month. It's like the smartest player at a high-stakes poker game quietly cashing in their chips while everyone else keeps betting. Most people have no idea this is happening, but the consequences are slowly making their way to your wallet. So, what exactly are these treasury bonds? Think of them as IOUs. When the US government spends more money than it collects in taxes, it borrows the difference by issuing these bonds. For decades, foreign countries, especially China, were eager buyers. Why? Well, China earned mountains of US dollars, selling us everything from iPhones to sneakers. They needed a safe place to park all that cash, and US Treasuries were the gold standard, stable, secure, and backed by the full faith of the US government. This created a symbiotic relationship. America got the cheap financing it needed to cover its spending, and China found a safe haven for its massive export earnings. It seemed like a win-win. The peak was in November 2013, when China held over $1.3 trillion. But then, things started to change. A few billion were sold here, a few billion there. At first, it was easy to dismiss. But now, over a decade later, the trend is undeniable. China is getting out. So why the sudden change of heart? There are three big reasons. First, geopolitical risk. When Russia invaded Ukraine, the West froze over $300 billion of Russian foreign reserves overnight. China was paying close attention. They realized that if tensions over Taiwan were to escalate, their massive holdings of US debt could be used as a weapon against them. Suddenly, what was once a strength became a major vulnerability. Second, it's about a shift in economic strategy. China is moving away from being the world's factory. They're focusing more on boosting their own domestic consumption and funding ambitious projects like the Belt and Road Initiative. The question for them became simple. Why lend money to America for a 4% return when they could invest it at home for much higher gains? And third, China is actively trying to reduce its dependence on the US dollar. They've been buying gold like there's no tomorrow, adding 225 tons in 2023 alone. They are also pushing to use their own currency, the yuan, in international trade, striking deals with countries like Saudi Arabia and Brazil. Every one of these moves chip away at the dollar's dominance and reduces China's need to hold US treasuries. Now, as China has been selling, another country has stepped in, Japan. By 2024, Japan became the largest foreign holder of US debt, with over $1.1 trillion. But this isn't a long-term solution. Japan has its own problems. Its population is aging rapidly, and by 2030, a third of its citizens will be over 65. The country's pension funds will soon need to sell foreign assets, including US Treasuries, just to pay their retirees. On top of that, Japan's own national debt is over 260% of its GDP, the highest in the developed world. When their own economic crisis hits, they won't be buying US bonds. They'll be selling them. This brings us to how the whole system works. The US Treasury holds weekly auctions to sell new bonds. When major buyers like China disappear and future buyers like Japan look shaky, the math gets ugly. If there aren't enough buyers, the US has to offer higher interest rates or yields to attract investors. Higher yields mean the government's interest payments balloon. In 2023, interest on the national debt cost $659 billion, more than the entire defense budget. If interest rates keep rising, we enter a dangerous debt spiral. More borrowing leads to higher interest, which requires even more borrowing. It's a cycle that's incredibly hard to stop. And here's where the story gets even stranger. A tiny country, Belgium, with an economy of about $600 billion, officially holds over $330 billion in US Treasuries. How is that possible? The answer is a financial institution in Brussels called Euroclear. It allows investors, including Chinese state entities, to hold bonds anonymously. So, when Belgium's holdings spike, It's often a sign of disguised Chinese activity. This means the official data might be understating how much China has already sold. The real situation could be even more serious than it appears. So, if foreign buyers are leaving, who's left to buy all this debt? American investors can only absorb so much. That leaves one buyer of last resort, the Federal Reserve. This is essentially money printing. The Fed can create new money to buy Treasury bonds, keeping interest rates low. But this floods the economy with cash, leading to inflation. It's the hidden tax that erodes your savings and makes everything you buy more expensive. The Fed already holds trillions in treasuries from past crises. Adding more is a risky game that could devalue the dollar and shatter market confidence. This isn't the first time America's creditors have lost faith. In the 1960s, French President Charles de Gaulle grew tired of holding paper dollars and demanded gold instead. Other countries followed suit. This gold drain eventually forced President Nixon to completely sever the dollar's link to gold in 1971. The dollar became a pure fiat currency, backed by nothing but trust. China's move today echoes that history. It's not an attack, it's a vote of no confidence. They want real assets, gold, commodities, infrastructure, not paper promises from a government drowning in debt. Financial crises rarely announce themselves. They build slowly, almost invisibly, until they suddenly erupt. Think of the 1997 Asian financial crisis, where entire economies collapsed in a matter of weeks because investor confidence evaporated. America is larger and more resilient, but no country is immune to the laws of finance. Confidence is everything. China's exit is the warning shot. It's the canary in the coal mine. The smartest player has already left the table. The US national debt stands at a mind-boggling $34 trillion, and we're adding nearly $2 trillion more each year. Interest payments alone are approaching $1 trillion annually. History shows us where this path leads. Great empires from Rome to Britain declined not on the battlefield, but in their balance sheets, when they could no longer pay their bills. China's selling isn't causing America's financial problems. It's a reaction to them. They see the math, and the math doesn't lie. They are simply protecting themselves from the inevitable fallout. The quiet exit of creditors is how empires transition from dominance to dependence. The bill is coming due, and the people who used to foot it are walking away. Thanks for watching. If you found this breakdown insightful, please hit that like button, subscribe to the channel, and ring the bell so you don't miss our next video. We'd love to hear your thoughts in the comments below.